All
So,
right.
all right. So we also have Shamsa on today. Shamsa is part of our Rise Realty and Tried and True Home Loans team. And he recently got certified for a down payment assistance program that he wanted to share with everybody. Shamsa, yeah, let's see here. You are unmuted. Good morning, Shamsa. How's it going?
Good morning, Travis. Everything is going well. Yourself?
It's going great, actually.
Awesome. Good to hear. And
Yep.
hello, everybody. Okay, let me share my screen first.
Yep. We can
So
see
this
it.
is the program that's available. The funding of it comes from the city of Los Angeles. And as a result, the homes, the subject homes have to be in Los Angeles City, not Los Angeles County. These are silent second loans, which means for 30 years, there wouldn't be any interest and there's no interest rate. It's for two types of home buyers or borrowers, I should say. One is low income, the other is moderate income. And the way they define the low income is if they have 80% maximum, their income is maximum up to 80% of area median income. This number, you can get it from the internet, obviously. And they briefly call it LIPA, low income purchase assistance. MIPA, on the other hand, is 81% to 150% of the area median income. On this one, on this page, we see that there's more restriction to it. For low income, it cannot be more than 70K for 1%, and so on and so forth.
So this is each borrower that's going to be applying for the loan, correct?
No, this is total
Or is that the
household.
household?
Yes.
Okay.
For MIPA, we have two types, 120 and 150. 120 meaning up to 120% of the AMI, and 150 is up to 150%. The interesting point is that, as you can see, the numbers don't change between these two rows, low income and moderate 120, except for $1 more for 120. But for the moderate income, 150%, the amounts increase, I'd say, by almost 1/3 or something.
Yeah, pretty considerably.
Right. Now, how much are the loan amounts and how much would be the maximum amount of the purchase price? For LIPA, the amount of loan could be $161,000. This is, by the way, the numbers that I'm getting. This presentation itself is from the Los Angeles City. And I checked, they don't have anything for 2024 yet. This is 2023. So for 2024, it might go up, I think. I don't know.
Yeah, probably a few bucks. So this would be the maximum on the silent second, correct?
On the silent second, correct.
Okay.
For the MIPA, as you can see, 120 is 115K, and for the other one is 90K, MIPA 150. At the moment, these two, like any of these two MIPA programs, the funds are completely committed and exhausted. So for this year, until further notice, there's no funds available for these two. For LIPA, there's plenty of funds this year. So that's something that I wanted to mention.
Okay.
So for MIPA, there is no limit of the purchase price. It could be a single family with no limit or condominium for any amount. For LIPA, though, as you can see, single family, there's this restriction up to $1,081,000. And for condominium and townhouse, townhomes, up to this amount. So you can use the funds for down payment, for closing costs up to 5%, and for gap or acquisition financing. That is also very nice that they showed some flexibility of usage for these funds. There are property requirements and borrower requirements. So the property requirements should be, as you can see, these just 1-unit properties. It could be any of these type of homes, condominiums, townhomes, single family. Manufactured homes though have to be on permanent foundation and connected to the permanent foundation. It could be a
Permanent
standard
utility
sale.
as well. So we couldn't do like a rural manufactured on land that has like a well, right? Or they want permanent
Well,
utility?
if
Well, I guess
it's
you could. It's just
if
not
it's a
saying public. Okay.
foundation, yeah, if it's a permanent foundation, it's connected to that
Yeah.
with
Okay.
hookups, permanent utility hookups, then yeah, it should be. Standard sale, bank approved short sales, foreclosed homes, REOs, all of them are covered by this program. It has to be a vacant home or seller occupied or a caretaker, as you can see here, but it cannot be tenant occupied unless that tenant is the prospective home buyer. So not every home in Los Angeles City qualifies for this program, unfortunately. There's this link along with a few other charts that later on, if anybody has any questions, by the way, they'll see my contact information at the end of this presentation. They can contact me and I'll provide them with more information. But to make it simple, they can use this link and type the property address. If the property pops up, that means that it's covered by this program. If it's not, then unfortunately it's not covered. So part of the homebuyer requirements are, as you can see, being a U.S. citizen, lawful permanent resident, or qualified alien. Be a first-time home buyer and not own any properties in the last 3 years. And basically, we covered this, that their total income for the household are those amounts, 70,000 almost for one person, LIPO, and so on and so forth. And then they have to use it as primary residence. And, this is just something minor. They have to complete an 8-hour buyer education, which could be in person or virtual. This is my contact information. I would appreciate if anybody has any questions to first try to reach out to me by email, but if need be, they can also call or text me.
So with this program, a lot of our agents have actually been asking about this in the LA area. You have to be certified, right? The loan officer needs to be
Correct.
certified in order to be able to do this one.
That is correct.
Yep. So you got certified a little while ago. The 8 hours of homebuyer education, can they do that? They can do it prior to putting in an offer, right? Like as part of the
That I am
pre-approval
not
process, I
sure.
guess.
I think I'm not sure. I can check with the Los Angeles City. Maybe they say yes, but I would say mostly it's only after. Yeah, after.
During the escrow process.
I can double check on that and get back to you or anybody
Okay.
that has the same
Yeah, just
question.
be curious, just to kind of get them really prepped, to
Well,
put in
this
the
doesn't
offer and
take
move
that
forward.
long though.
Yeah,
This
it's
8-hour should be yeah, should be
yeah.
quick.
Okay. Cool. Well,
Um,
if you have any buyers looking in the city of San Diego, not the county, but the city, and they want these down payment funds, this works a little bit like that Dream for All program that, there's a lot of buzz about. This is kind of similar to the original version of the Dream for All program, not the current version, but it's basically, it's as if your buyer is going to come in with 20% down. So it really drops their house payment down considerably. So, we're looking at that $1 million price point for what would be considered a low income borrower, it does bring homeownership a little bit more into focus for them because um, it's as if they're coming in with a 20% down. So it really adjusts their payment down considerably. So it's a really good
Absolutely.
program. We put a few people into the Dream for All on the original one. It was a great deal for them. This is very, very similar to it, in my opinion, to the original. And there is some in other areas. City of Santa Ana has this. There's lots of City of San Diego just came out one that's pretty similar as well. All of them providing, kind of a silent second 20% down payment. So if you have any borrowers that are just a little bit priced out, um, maybe they're homeownership is just out of reach for them. Let us know, and maybe we can look into some of these area programs if they're willing to relocate a little bit into some of these other areas and take advantage of these programs. There's some pretty good opportunity out there.
So let me add a few things. Absolutely, to your point, in most cases, this amount of 161K should be around 20%, or if not more, basically, which means they can drop their PMI.
Hmm.
That'll bring their monthly payments down as well. There are a few downsides of using this program that I have to mention also, because that's important. So if you're out there trying to get your offer accepted, you need to look into, basically you need to have an escrow time of at least 60 days. That would be one major downside because not every seller is willing to accept that. But that's required because of this silent second loan, which has its own processes, and that those take a while. We need to reserve the funds. We need to communicate with the city. There's a lot of back and forth with their underwriting and so many other processes. So we require to have at least 60 days of escrow. In some cases, we can close sooner, but it's better not to basically have any offer of yours that's accepted to be less than 60 days.
Yeah.
Shamsa,
Yes.
is
Hi,
the
Andrew.
did you go, good morning. Did you go over the what's the repayment of the silent second? Did you mention that? Is it a shared equity?
No. So the repayment, it's only when you sell the property or when you pay the first loan. There is no repayment for 30 years. There's no interest, nothing. I mentioned
So
at the beginning.
is there no, but if you borrow 100 grand, it doesn't matter about the price, but if you borrow 100 grand as the silent second and you sell in 10 years, are you only paying back 100 grand?
No. Okay, so those are, I thought maybe those are the questions that, but I can explain a little bit, but I thought maybe the borrower would be more beneficial to them. But if the realtors want to know as well, yes. So when they sell the property, they have to repay the original amount of funds that were available to the borrower, plus if there was any appreciation, an amount proportionate to their total funds that they got from the Los Angeles City. For example, if they got 1/3 of purchase price as a fund, then when they sell, they have to return that original amount plus, and on top of that, 1/3 of the appreciation of the home. So that's what they need to repay. If there was a decrease in the amount, there was depreciation, then they have to return the original funds. That's all.
Oh,
there's more details to that, and there's more calculations. For example, if the borrower basically did any remodeling on the home, they would consider a part of that, as the money that they spent, so they don't have to return on the appreciation. Basically, they can deduct from the appreciation and things like that. So
Okay.
there's more to that. There's more details to that.
Yeah.
This is awesome. Yeah.
Yeah.
With the where, and I've looked into these as well. So I have I think 7 people trying to get a voucher in the lottery system right now for Cal Haffa. I mean, I could have 7 deals or I could have none. I don't know, but hopefully I have 1 or 2 or all of them would be great. But this is where this program and what Shams has done is he's probably one of 5,000 mortgage professionals that can offer this program to your buyers because he's gone through the training. And, additionally, if you're working with Shamsa on this program or the idea to market something like this, you have some very specific language that other realtors wouldn't be able to use. And where this becomes incredibly powerful for both you and Shamsa is that you can talk about the money that can be given out through this program as a benefit when you're trying to drum up business. I mean, these are incredible, and there are most counties throughout California have something like this. This actually sounds like it's Los Angeles City, which is unique. I know there's an Orange County one. I know there's San Diego, like Travis said. Riverside, I've seen. But these are really incredible, and it's, having Shamsa has gone through this one is great. Because I keep looking at it myself, but I haven't been willing to invest my own time to get certified.
Yeah.
Yeah, there's
So
one
congrats
for
on that, man.
there's one for LA County, which I will be trying to get certified. I think that's at the end of each year that they certify, new people. So I
And
have to
give
wait
me
for
let
that.
me
Yeah.
jump in 1 second on the math with this. So Travis mentioned one of the Cal Halfa loans that I did last year, and it was actually for a Rise agent. And I he's a year into owning his property. His property's probably gone up about 8%. He was able to purchase that home. It was $100,000 higher than he would have qualified for without a program like this. And let's just say that he never was able to. But if that house was available today, even at the same price it was last year, which it's not, it's gone up in value, his income hasn't increased enough to be able to qualify for that purchase. So they're living in a house that they never could have afforded, but because of a loan like this, it's allowed them to have a slightly bigger house for their family that they're also benefiting from financially based on equity growth. And they're making a payment that is in range with what they would normally qualify for. So they're not being stretched by any means possible if they use that program or anything else. Yes, they will have to pay back a little bit of money out of the profit, just like this program, but no money will ever be paid towards that second loan that gave them that opportunity until they've made a bunch of money. So I mean, these are incredible programs. So
Yeah.
you should definitely get if you sell in LA, you need to talk with Shams about this.
Yeah, definitely. All right,
One
Shams.
last thing, sorry, before I
go
go,
ahead. Yeah.
is that for refi, they need to request that refi to the Los Angeles City, and sometimes they approve those. So they can refi their first loan for better terms, let's say in 2 years from now, and still have that second be in place, remain in place.
So they'll let you resubordinate the second at least once.
Yeah, you keep the second, and you can refi for better terms of your first mortgage in the future if you want to, if they approve that.
Awesome.
Yeah.
Okay, thank you for the opportunity, Travis and Andrew.
Yeah. Thanks for
Hey,
coming
man,
on.
I'm happy for you, dude. This is an awesome program.
Thank you.
Awesome.
Bye.
Cool. All right. Well, I'm going to grab the screen and we will roll into some fun stuff. Leasing versus property management services, the Tenant Protection Act, which we're going to refer to as TPA as we go through this, and the RCJC form, which is the form that you see included in with the leases now. So, and that is the rent cap and just cause addendum. So, We'll go through a few things here. Now, we don't offer property management services here at Rise Realty, at least not at the moment. There's some reasons for that, but we do permit leasing. And so leasing would be what I consider or call tenant placement services. So, you have maybe you sell a home to an investor and they would like you to get a tenant in place for them. Can you charge, a fee to that owner? Yes, you can, for your services of marketing the property and getting a prospective tenant in place. Now, it seems, over the years, this has definitely gotten a little more strict, and there is liability still involved with leasing in the fact that you are putting a prospective tenant in place for this homeowner, and you don't want the homeowner to come back in any way and say that you didn't do a good job at it, and have any liability there. So we're going to go through a few things here. I do this from time to time with some of my clients, just tenant placement services. It's a good little source of money, if you have that available and that type of network. So, does the brokerage permit leasing or property management? So leasing and property management are licensed activity, both of them. Sales agents can only conduct licensed activity through their brokerage. Now, if this is personal property, then that is going to be a no. We don't need to do that. If you're going to be placing your personal property into the MLS, then yes, we do need paperwork and such on it. But if you are managing your own properties, then it does not need to go through the brokerage. We do not permit property management, though, which is where you are going to collect a fee. You are collecting rents from homeowners, or on behalf of homeowners. Those are trust funds. We do not permit that. Leasing, tenant placement services, yes, that is permitted. What are the reasons? Why do some brokers not offer property management services? Lack of familiarity with leasing and property management. The agents are acting on behalf of the brokerage, and if this is not something you are well versed in, it really creates a huge liability for both you, the homeowner, and the brokerage if you don't know really what you're doing with the property management. You'll notice that a lot of brokerages that do offer property management, a lot of them are property management heavy. That is what they do, and then sales are kind of on the side. Or they have dedicated people handling the property management services because they are well trained and they have systems in place for the audits and everything else that happen. Insurance does not cover this activity. Some, carriers do not cover property management services. The risk is different from sales, fair housing, trust funds, things like that. You deal with fair housing considerably more. You're exposed to it a lot more with prospective tenants. A lot more claims can come from that with prospective tenants, claiming that they were excluded for certain reasons. So you'll see that happen a lot more often, and I'll touch on that a little further into the presentation. Property management activity has to be reported to the DRE in a broker's renewal application. So we do have to report any property management activity going on. So those are just some of the reasons why many brokerages prefer not to have property management divisions in place. So let's talk about attaching and filling out the Tenant Protection Act exempt notice. So in 2019, California passed a statewide rent cap and just cause eviction law, also known as the Tenant Protection Act. Single-family properties, condos, townhomes may be exempted, but are not automatically exempt if not owned by a corporation or a REIT. The notice exempting these properties must be attached to the lease. The RCJC form is the disclosure of that. So that's why they attach that in. So let's go over that form, the RCJC, also known as rent cap and just cause addendum. I forgot to type in cause right there. So exemptions from rent cap rules. Housing that has been issued a certificate of occupancy within the previous 15 years. So what can be considered new housing. A duplex in which the owner occupies one of the units at the commencement of and throughout the tenancy. A single-family residential property, including condominiums, so long as the owner is not a corporation, not an LLC, which one of the owners who is a corporation, and not a real estate investment trust, also known as a REIT, and the owner gives the tenant a legally required notice of this exemption, which would be in the RCJC form. Ownership by individuals, partnerships, individual co-owners, trusts, and LLCs with no corporate owners all qualify for the exemption. So giving notice of the rent cap exemptions, CAR Form 8 RCJC may be used as follows. For month-to-month tenants, for new tenancies starting on or after January 2020, so we're quite a few years past that now, incorporate the RCJC into the rental agreement, and again, it is already included in there. For existing tenancies, so maybe someone's been renting all these years, incorporate the RCJC by using a change of terms of tenancy, such as the notice of change of tenancy form CTT. For fixed term leases, for new tenancies, same thing. After 2020, incorporate it, and same thing for existing tenancies. So a little bit of Q&A. Does the TPA, the Tenant Protection Act, preempt local rent control ordinances? Local government rent caps if a city or county limits rent increases to an amount less than authorized by the TPA, then the local ordinance applies. So that's going to supersede. If a government entity is not as restrictive as the TPA, then the TPA applies. Does the TPA limit the rent that an owner may charge a new tenant? No, it does not. The initial rental rate charged to a new tenant is not subject to the rent cap in the TPA. Subsequent increases to the new tenant will be subject to the TPA. And again, TPA is Tenant Protection Act. Is it necessary for an owner to hire a lawyer before attempting to raise rent or evict a tenant? The application of the TPA and its exemptions and requirements, as well as the interplay between the TPA and local ordinances, can be complicated, and failure to abide by the law can have severe consequences. If you haven't been following, in California, it has definitely been getting more strict on homeowners who are renting out their properties. It is definitely becoming more restrictive. So this is another reason why we don't really do property management here, is because these laws are changing very fast. And they're not just uniform throughout California. There are many, many local ordinances that need to be kept up with. And so, if you're not keeping up with them, you could really be putting yourself in liability and the homeowner. So that is just another reason why. It is recommended that a property owner consult with a qualified real estate attorney familiar, not just with TPA, but also with the local law. So you want to, if you're referring someone out, make sure that they are familiar with the local ordinances as well. And there's many attorneys. There's also eviction companies and things like that that really keep up with local ordinances. And that's where I personally refer homeowners over to those types of services, because I personally do not keep up with every city's local ordinance. I mean, it's too crazy. So I would not recommend answering this question if asked by a homeowner. We don't provide property management services, and we should not provide advice on property management questions. Really, you want to refer that out, just as you would with other things, tax questions and things like that. We're not CPAs, we're not attorneys. Can we direct them to places? Yes, definitely we can, and maybe provide some resources. But unless you're well versed in this stuff, you really should not be answering a lot of these questions for these homeowners. So let's go into what are reasons an owner may evict a tenant or at fault just cause. Default in the payment of rent, a breach of material term of the lease, the tenant commits a nuisance or uses the property for criminal or unlawful purposes. The tenant assigns or sublets the property in violation of the lease. The tenant refuses to allow owner access. The tenant refuses to sign an extension/renewal at the expiration of the lease rental. What are the reasons an owner may evict a tenant for a no fault just cause? The owner is withdrawing the property from the rental market. The owner intends to demolish or substantially remodel the property. This does not include cosmetic improvements alone. Those do not qualify. We're talking substantial updates where the property would become inhabitable because of the updates to the property, the remodel. The owner or the owner's family members intend to occupy the unit provided the tenant has previously agreed to allow such a termination, or if a provision of the lease permits it. Car form RCJC may be used for this purpose. So you'll want to make sure that has been served to the tenant. For all no-fault evictions, the owner must pay the tenant a 1-month relocation fee or waive rent for the final month of tenancy. So let's talk about leasing a little bit, tenant placement services. We do have a few on the team here that do this fairly regularly, and you want to make sure that you're following and you have procedure in place when you're doing these services. So set reasonable, non-discriminatory eligibility standards and stick to them. That's where you can really land yourself in a lot of hot water, as if you're kind of waving on what the eligibility standards are for prospective tenants looking to rent that property. And it should be property to property to property, not just for that specific property, but you should have a standards of practice in place. The application and selection process must be non-discriminatory. We all know that, but do we actually have procedure in place? That's what you want to look at and ask yourself if you're going to be providing these types of services. So the first step to achieving this is to establish a minimum criteria which all applicants must meet. And again, not for just that property, for all properties that you're going to be providing tenant placement services in. The criteria may include credit standards, verifiable income, income to rent ratios, eviction history, rental history. A conservative risk management approach is to work with the first tenant who has provided a fully completed application that meets the criteria. So if you have this criteria in place and you have applications out, and whoever completes the application in full first is who you should try and work with first. That would be the best approach for risk management. I'm going to check the Q&A here. Looks like we have a few. I want to remove 10. Okay, not a question. So consistent fair housing procedures for leasing services. So applications, make sure to offer an application to all prospective tenants who come to the property. That's why sometimes when you walk into a property that is for lease, you'll just see a stack of applications there, and everybody's encouraged to take one. That is a great way to ensure that you have offered applications to everybody who's walked in the door. Their opportunity is right there on the counter. Make sure each application is completely filled out. Get one application from every person over 18 years of age. Differential treatment. Ask all phone applicants the same non-discriminatory questions. Use the same phone sales techniques and same enthusiastic tone of voice. You don't want to have inflections in your voice that may, I guess, discourage somebody from wanting to make an application there. All of these things can come back to haunt you, actually. So provide all applicants with same info about the property, available units, rent, and security deposit. Handling discriminatory questions. So what would an example look like? What kind of people live here? Your answer: we're an equal opportunity housing provider, and everyone who meets the qualifications is welcome here. Don't be afraid to sound scripted when you're dealing with prospective tenants and things like that. And just leave it at that. I mean, you don't need to, less is more. You don't need to go into long stories or anything else. Keep it short and simple, and refer to being an equal housing opportunity provider. So let's talk a little bit about Section 8, because this does come up as well. So a tenant cannot be refused on the basis that they're applying under a Section 8 voucher. Some Section 8 do's and don'ts. Do not advertise that Section 8 tenants are not accepted, nor any restriction on that basis. Starting January 1st, 2024, offer the Section 8 tenant the option of having their application reviewed on the basis of their ability to pay rather than credit history. One of the do's is, if tenant does not elect ability to pay review, then check the credit of a tenant, including Section 8 tenants. They can apply to rent they can apply a rent to income ratio, but the ratio can only be applied to that portion of the rent for which the tenant is responsible. Another do is the landlord can set their own rent, even if the rent is higher than the amount that the local housing authority will pay. Some don'ts. The higher rent amount may be a basis for automatic denial of a Section 8 tenant. The landlord must engage with the housing authority to see what they will offer. Another don't: the landlord cannot deny a tenant outright on the basis of perceived delays. Do: the landlord may charge their normal security deposit. Service animals, this comes up a lot, and emotional support animals. So those are in two different categories. Landlord must accommodate the tenant by making an exception to their no pets policy. For service animals where the disability and the need is obvious, no documentation can be asked for. For animals where the need or disability is not obvious, such as an ESA, which is emotional support animal, the landlord may request documentation that the tenant is disabled and that the animal is needed to reasonably accommodate the tenant's disability. It is not required that the tenant disclose their specific disability, and the landlord cannot inquire about it. The verification may be provided by a medical practitioner or any reliable third party in a new position to know of the disability or disability-related need. Online certificates given without any individualized assessment of the disabled person's condition do not qualify. But if faced with this, the landlord should engage in an interactive process and request additional information. Trust fund handling. trust fund violations are the most common violation found in DRE audits. Of the 10 most common audit violations, 7 are some type of trust fund violation. Again, this is the major reason why we don't offer property management services here, because trust fund violations are so common and they are the easiest way to fail an audit, and they know it. So the category of trust fund violations include setting up a trust fund account. Record keeping requires maintaining a separate record for each beneficiary or transaction, in addition to a record of all trust funds received and paid out. That line alone, just the accounting of it is there's a lot that goes into that, and that's why property managers use a lot of software and things like that. And that is where a lot of the audits find the violations, is in the record keeping. And also in monthly reconciliation, which is number 3, no commingling, improper supervision. So the reconciliation and the record keeping, in my opinion, are the most crucial, and where they find the most violations with the audits. So this means that property managers need to build expertise in trust fund handling. Accepting any funds from a tenant on behalf of the landlord is considered trust funds. This includes credit application fees. So if you are doing leasing services, you cannot collect the fee for the application or for the credit report. And that's why I recommend using a third-party source. I personally use Rent Spree for this. I have the link available. That's where they apply for the home that I have for lease, and that is where they also pay for their credit report, as through that third-party source. So I am not personally collecting any fees from the tenant. Again, do not accept payments of any kind from applicants or tenants. Some additional property management pitfalls, leasing included. Duty to maintain habitability. So this is a big one. Avoid properties that require a lot of repairs, or where the owner is unwilling to do repairs. Even the act of tenant placement services can involve you in a dispute between a tenant and a landlord. So if you have a owner who just refuses to maintain property, they don't want to put money into it, you go and view the property that you're going to go and do tenant placement services on, and it is not in good condition, rips in screens, leaky faucets and toilets, toilets that don't flush properly, even flooring that is in very poor condition, things like that. If the owner is not willing to correct those, you could get involved in that dispute between the tenant and the homeowner. So, we all want to make some money here, but be selective, because the money is not big money with these, and it's really not worth the risk, in my opinion, to take on properties like that and place tenants into them, because you can get involved in that. Disclosures are different from sales. Lead disclosures are especially key for those properties that apply. Termination notices, avoid providing any termination notice except with the advice of an attorney. I see a lot of agents trying to be helpful. They're trying to get the listing, and the owner is trying to get some free service out of the potential listing agent, and say, hey, I need to serve notices to this tenant, can you go do that? I say no. Personally, I don't even do it. I refer them to a eviction company or other, and let them handle that liability of serving notices, because if it's not done properly, then it's going to come back on you. And if you're not well versed in it, don't get sucked into that trap. Just refer them over to tenant placement services. Say, this is not something that, blame it on the brokerage if you want. We have a policy against doing this. That is, something for an attorney or someone such as an eviction service to go and serve these notices. Deductions from security and lease ends. Avoid getting in disputes over disposition of the security deposit and lease end when money is held in a trust account or with the owner directly. Now, it should not be in a trust account because we're not offering property management services. If you're dealing with an owner that is holding the money themselves, they're self-managing, avoid getting in between that. That is between the owner and the tenant. And if you start getting involved with that, now you're practicing property management, and we don't want to get sucked into that either. So we'll close with some local rent control notices. Again, agents are not attorneys and are not expected to research local rent control laws or other local notices, nor draft such notices. But they should have sufficient familiarity with local notices to advise their clients on the need to have local disclosure or notice. Are you keeping up with this regularly? If not, don't provide advice. If you're not keeping up with every city, every county, what they have going on with local rent control notices and things like that, don't try and provide advice. Send them over to an attorney or something like that where they can get proper advice. An example is the city of San Diego has local just cause eviction laws. So those are different from the state ones. The exemption notice, similar to the statewide exemption, but in fact is a different notice. The deadline to provide the notice for existing tenants is 9/21/24. Beginning 2024, it must be provided in the lease. If not exempt, special notice must be provided and the tenant protection guide given directly, and notice of right to operate daycare. So I know it's probably a little bit of a dry topic, but I wanted to touch on it mainly because of, I do get asked that question a lot about property management, but also just tenant placement services. It seems like, something you're doing as a courtesy and different things like that, but in fact, it does come with liability for performing those acts. So keep that in mind. If you're going to be doing that, look into what the local ordinance is in, get familiar with the forms, and take some classes. You can ask, obviously, call and things like that too, but I recommend taking classes if you're going to be doing this regularly. If you work with some investors and, part of your service is going to be tenant placement services with those investors, get to know the local laws and ordinances and get very familiar with the forms, and don't get sucked into property management, just tenant placement services. So hopefully that provided a little bit of clarity for you. I know, again, a little bit of a dry topic, but I felt it was something that we should definitely touch on, especially with all of these changes that are coming about very, very fast with the state, with tenant protection and things like that. So hope everybody has a great week. If you need anything, I'm always around. Call, text, email. And you can always schedule an appointment with me as well with my Calendly link that is in my email signature. It's also in the back office. And I will provide a copy of this in the recording in our Facebook group. So hope everybody has a great week, and we'll talk to you soon.